Okay, in this video, I want to take a look at capital acquisitions tax in Ireland. This video is going to have a look at capital acquisitions tax, what it is, and it's going to give you a general overview. Hopefully, it'll be useful for you if you are the beneficiary in a will, or indeed if you've received a gift from somebody and there may be a question of a tax liability. So, capital acquisitions tax then comprises two taxes essentially. One is a gift tax and the other is inheritance tax. And the relevant legislation is the Capital Acquisitions Tax Consolidation Act of 2003. The calculation of tax then that's due is payable or is based on excuse me, the value of the benefit, the relationship between the donor and donee, and any prior benefits received by the donee. So we looked at the value of the benefit. Calculation of tax is based on the value of the benefit and the relationship between donor and donee. So what is the value of the benefit? It's the taxable value of the property. That's calculated by looking at, firstly, the market value of the property. We're considering here real property, a house or a farm or something like that. But it could be shares in a company or indeed a company or something else of value. So you look at the market value of the property, you look at liabilities, costs and expenses and any consideration that might be paid for the benefit, and that leaves you with the taxable value. The tax then is payable or will be determined by the relationship between the disponer and the beneficiary. For example, was it from a parent to a child? Was it from a deceased person to a niece or a nephew, or to a complete stranger, or just a friend? The key thing in this tax in relation to capital acquisitions tax is the groups of relationship between donor and donee, or between testator and beneficiary in a will situation. There are three groups. Group A is from parent to child. So that has a maximum exemption of 310,000 euros at today's date. So that means that if a parent leaves a child some land or perhaps a house or a shop or something, some real property that's worth 250,000 or up to 310,000, well then the child can take that without any worry about tax. The group of relationship though is critical. So group B then comprises a brother, a sister, nephew, niece, grandparent, grandchild, lineal ancestor or lineal descendant. So this is where somebody might leave something to a brother or a sister or a nephew or a niece. The tax exemption there is much less. In fact, it's nearly 1/10 of the group A. That's key, and that's obviously going to lead to a tax liability. Likewise, group C is anyone else. So if you're not a child, if you're not a brother or sister, if you're not a niece or nephew, if you're a stranger essentially to the donor or to the testator in a will situation, then the tax exemption threshold is only 16,250. That's very small. Obviously, if you only got a field or something off somebody, it could be worth anything from 25 to 50 grand to even more than that. So clearly there's going to be a tax liability arising there. These figures are correct at the 30th of July 2018. They do or are changed regularly in budgets, but that's the current situation. Limited interest then are something that you need to be aware of as well. A limited interest is something like a right to reside in a property. Or a life interest. So a life interest would be a right to reside in a property to the exclusion of everybody else. It's an exclusive right. A right to reside, an ordinary right to reside is the right to live in a house, but perhaps with somebody else. An interest-free loan or a free use of property. All of these are limited interests. They're not absolute interests, they are limited interests, but they can give rise to a tax liability because they may have intrinsic value, and it'll depend on, in relation to, for example, the right to reside or the life interest, what age the person is, how long they're likely to live, and this will be calculated by the use of actuarial tables. So you need to get tax advice if you are the beneficiary of a limited interest. The valuation date then, from a legal perspective, in terms of calculating the tax due, will be the earliest of three dates. One is the date the executor or administrator can receive the inheritance to give to you. Two is the date the executor or administrator actually receives it to give to you. And three is the date the executor or administrator actually gives you the benefit or the gift that you're receiving in the either a gift or in the will. For a gift, the valuation date, in effect, in practice, is normally the day that the gift is handed over, and in an inheritance situation, it's normally the day that the deceased person, passes away. Return deadlines then, where the valuation date is between the 1st of January and 31st of August in a particular year, the deadline for payment of CAT is 31st of October in the same year, and where the calculation date is between, or the valuation date that should read, is between the 1st of September and 31st of December, the deadline for payment is 31st of October in the following year. The rate of tax up to the threshold amount, obviously it's tax-free, it's nil, and once the value of the benefit exceeds your threshold, well then it goes to 33%. Excuse me. There are various exemptions and reliefs, and these would include the likes of agricultural relief. There's a small gift relief in relation to gifts. There's spousal relief, there's dwelling house relief, there's business relief. There's a lot of reliefs. You do need to get tax advice if you are the lucky person who is in receipt of a significantly valuable benefit. My name is Terry Gorey, as you can see on the screen there. There are my contact details. I hope you find this video useful. If you do, you might give it a thumbs up down below, and you might be interested in sharing it with somebody for whom this may be of particular benefit or interest, because they may have come into some property or some land or whatever. Thank you.